What's going on, everybody? Welcome back to the CoWaCo, as we in the building. And I'll just mention to you all to make sure you all subscribe, like, comment, and let y'all know that we are not financial advisors. So, letting you all know that.
We can give you good advice.
Yeah.
But legally, hey, okay, we give you good advice, but it's free. So invest at your own risk.
Yeah. All right. So we're going to start off talking about kind of continuing a little bit off on what we talked about before. Fractional shares.
Yes, sir.
So.
Yes, sir.
Got anything to say, Chris?
Let's get to it. All right, ladies and gentlemen. Like Leroy said, the sensei, welcome to the CoWaCo, the company water cooler. I am Chris. That is Leroy. We're going to get into fractional shares. So fractional share, for those who are unaware, is a portion of a fraction of it's a portion of ownership if you want to look at it like that. So if one share is $100, a fractional share is going to be everything under that $100. You can still invest it. You can still get a piece. It is still a piece of that pie. It's just a small piece of that pie. It's a micro piece of that pie. So if I have $10 to put into this $100 share, I have a tenth of a share of a company. I still have a share, right? If I get a tenth of a pie, I'm still eating pie. It's still a tenth of a pie. If I get a tenth of a tenth, same thing, so on and so forth. A fractional share is still a share, right? You have to think about it in terms of a fractional insert whatever here is still a fractional whatever. Half of a house is still a house. It's a half a house, but it's a house. And you'll eventually get to the point to where you understand the whole house, or you own the whole house. Hopefully you're not out here buying half houses anyway. And you're buying them. Hopefully nobody can sell you on a half a house. Hey man, let me cut out half of this house. You get this half, they get that half. Unless you're talking about a duplex, but that's a different story.
Right.
But a fractional share is a small portion of a share of a company, but it's still ownership in the company. So if you don't have $1,000 to buy a full Tesla share, but you have $100, you still have ownership in Tesla, the company. So that is what a fractional share is. And Tesla is actually one of the companies I know we'll talk about later in the episode, because they do have, it's not set yet, but they do have, today is the 2nd of April, 2022. So they do have, they're in talks now to get a split sometime, I believe, next year. The paperwork and everything is being sorted out now. But once that happens, for sure, Tesla's a good investment now. It's a good investment then. But when that company splits, well, no. So from the one they have now, what are they at? Like 1,000 now, right? Yeah. They're gonna do their and who knows what they're gonna do? 5-1. I mean, probably not 10-1, but maybe they might. But they're interested in doing a split for next year. So Tesla won't split this year, likely, unless they get all of that stuff in and they clear everything with the Securities and Exchange Commission before December. But December, January is corporate tax season, so they probably won't split then. But Tesla is looking at another stock split, yes. I mean, because it reached that point again, Leroy, where everyday people can't afford it. So, you know, that's how it is. And Amazon and Google we'll talk about later as well, because they have a split coming up. So that's fractional shares, everybody. That's what a fractional share is.
And also to piggyback off what Chris just said, it's kind of like you are doing, I guess, is it like dollar cost average?
You could do that as well, yes.
Well, okay, so, well, actually, what is, I guess, let me ask then, what is dollar cost average then?
So dollar cost average is when you decide that you're going to invest a certain amount of money every certain period. So if I decide that every month I'm going to invest $500, I'm going to get in at the top tier companies every month because we don't invest in scrap. I want to invest in the top tier companies. So I'm going to take every month, but disregard that. Dollar cost averaging is me taking $500 every month, investing it in the market, no matter where it is. Because eventually when stocks come down and they correct and we get them right there where we want them, 30, 40% off, we wait a little bit for that. But dollar cost averaging says that I'm going to put $500 a month in the market no matter what. And which means I'm going to buy some companies at a high. I'm going to buy them at a low. I'm going to buy them in the middle. But I'm going to you want to dollar cost average down. Obviously, you can dollar cost average up, but that's not smart. So when we say dollar cost average from here on out, we're talking about buying a share at $1,000, right? Because maybe you're new to investing. That next month, that company is down to $990, so you invest there. That takes your average down, your average cost per share down from $1,000 to in between $990 and $1,000. The next month, that company goes up to $1,100. You still invest your money, but now your average is still greater. So think about it in terms of a race. Whoever is at the beginning of that race and whoever is at the finish of that race, you have the loser, you have the winner. Everybody in between is average. You think about it like a race, you think about a bell curve. At the end of that bell curve is the extremes on both sides. But you have that average in the middle, that's that range, right? That was a pretty vague, very general example, but when you dollar cost average, it's sort of like, it's a smart way of investing because you don't want to just sit your money on the sideline and wait for eternity to invest. So you want to get in and constantly get in these good companies, because even if I pay $1,000 a month for this share, it's $1,100 next month, $1,200 next month, $1,300 next month. I'm still dollar cost averaging up, but it's not going to run up forever and ever and ever and never come back down. Support and resistance, we'll get into that later. But companies do reach a point of support where they're not going to fall below a certain amount of money. And so your average is going to be, hopefully your average is below that and you got in before it skyrocketed and took off, right? But when you think of dollar cost averaging, just think of you spending too much money on something, realizing it's a good asset, sticking with that asset and purchasing constantly. You continue to buy, you continue to put money into it as that price comes down, and then as that price goes up. You'll learn a strategy once you dollar cost average down. I'll give you an example. Tesla is $1,000 right now. So if I go and I get one share of Tesla right now at $1,000, in 3 weeks, it's down to $950. I'm going to go back in and buy another share at $950. So I'm going to bring my total down from $1,000. If Tesla runs up to $1,200 2 weeks after that, my shares are now worth more than the average cost that's associated with those shares. So I can either sell, I can buy, or I can wait for it to come down a little bit, maybe like 1,100 range, 1,000 something, and dollar cost average up slightly because I believe in Tesla. And I know that Tesla is going to continue to grow and it's going to continue to expand. And then eventually, once I own 10 shares, 100 shares, 1,000 shares, now I can sit and I can wait longer to put money into this asset at a much, much lower price. It runs up. I sell here, I take profit. I invested in other quality assets, 3 or 4 other companies. I wait for it to go down. I buy in, it goes up. I sell, wash, rinse, repeat, right? So when you dollar cost average, you're looking to get, you're not hawking the market. You're not looking to get, okay, I'm absolutely gonna wait until this. No, it's a consistent investment. Every week, every 2 weeks, every 3 weeks, every month, and you're putting money in constantly into these good companies. and the
Right.
price of your entry is slowly going to come down.
So that kind of leads us into our next topic with actually asking about dollar cost average.
Okay. Okay. Let's get to it.
So I know we mentioned when he was talking about the dollar cost average, where you were investing, and again, in quality companies, not
Quality.
just any type of company out there. If their
Right.
finances not looking good, if they're looking good on a chart, are they being innovative?
Right.
You got to keep all that in mind whenever you're actually investing in the companies. So where like we're using a small amount, and this is what we're going into, a small amount of money within to these quality companies where you keep putting money in, like Chris was saying, each week. Kind of
Yep.
like concept of what we call it, micro investing.
Micro investing. So we want you all, what we're attempting to do, we want you all to just get in the market. We want you to invest. All of these videos, these are investment videos. All of these videos are going to be about investing. You don't have to have $1,000 to put money into the market. $1, $5, $10, $20, right? Put your money into these companies consistently. Consistently do that. Every week you put 1 in, 5 in. Every week you put 1 in, 5 in. We want you to invest because $20 a week for 12 weeks a year. Let's break it down. Let's break it down by monthly, annual. $20 a week invested, $40 every 2 weeks, $80 every month, $960 every year. I'm not going to ask you, most people I can't ask to invest $960 right now. But over the course of 12 months, I can certainly do that. A cup of coffee costs $15. A salad at the store costs $20. A slice of pizza is not even, $3, $4 anymore. A slice of pizza, you got to get the personal pies now for like $15.99. So if I'm saying, I'm saying micro investing every month or micro investing, I want you to take that, take $1 or $2 here or there and put it into a company, right? And I mean, do that when the market is open, but even if you have it queued to invest the next day, you can do that. So you can set it and forget it. So if I want to invest $10 every week, and I don't mean to mention a dollar amount to give you one, but anything from $1 to $100, right? If you've got $100 every week to invest, fantastic, do that. Don't ever stop. Don't wait. Don't pause. Oh, something is going crazy. No, take that money and put it in on a consistent basis. And you're not even thinking about it because you know that the companies that you're putting your money in are quality, right? So it's a slow build. Think about that avalanche. That avalanche didn't start as that 50-foot snowball. It didn't start as that. It started one flake at a time. The little snowball hit, fell off the tree. It compiled. It started gathering other snow. Once it comes off that cliff, man, is it a rush, right? And that's that build up. That's that pile up. That's that compound investing, right? So micro investing is compound investing. A small amount, and don't check it every day. You got good companies. Don't worry about it. They'll take care of themselves, and they'll take care of you by doing that. So check every 6 months or check every year. At the end of the year, check your micro investing. Okay, this year it was 960. It's absolutely going to be worth more than 960 at the end of that year, right? Especially if you're putting your money in good companies. You'll probably get on a given year with quality companies, good companies, 20, 30, 40%. That's great, right? For you to get, if every year you could get 40% return or 30% return, I mean, I'm cool with it. As long as you beat inflation. Hey, if inflation is 12% and you make 15%, yeah, you only made 3, but it's still 3%, right? That's still small, but you still beat inflation. You still beat the pricing of bread and milk and eggs. So it's that slow build. You want to compound that.
Yes. And like for example, one of the apps that we talked about before, like I don't even have a savings account with no bank
Right.
or
Yeah.
credit union. I use Cash App now. So
Yeah.
what I do each week is I put in $50 each week into my Cash App with my 7 stocks that I actually have. So
Right.
I basically divvy up in those particular stocks where I take that 50 and I split it up among those 7. And I put it in there, each week.
Right.
After I get paid. So I know entertainment. I'm just giving an example. So like whenever you go out and let's say you're doing some type of entertainment, right? And when I'm saying entertainment, like you're going out to eat, right? Let's say you're going out to the club. Hey, party!
You could do that.
So,
You could do that.
So think about that $20 that you about to spend on food, another $20 going to the party. And then if you're a drinker, oh man, that's another $20, right?
Yeah, well, that might be 50, but yeah.
Say that again.
Yeah.
Yeah. So
yeah, it might be.
Huh?
No, that might be $50. Yeah,
Right.
50 or 60. Yeah.
So just think about this. Instead of you putting it into the entertainment, you putting it into something where basically you're gonna get money back. Because you're not getting money back by you actually spend on that 20 that you went to eat, that party, and then also you're buying the drinks. Hear me out. Now, if you had put that within the into your investments, that following week, look, you might have some cash that actually built up. And let's say you want to maybe like treat yourself maybe later down the line. And Chris say within like that 6 months that you have actually had keeping it in check. And you look back like, oh man, well, you know what? I want to treat myself. So you can maybe pull a little bit, maybe money out, during that time to splurge a little bit on your entertainment.
Of course. And I want to make a note, Leroy. I want to make a note about companies that give dividends. Dividends are great, but you don't have to. And what a dividend is, for anyone who might not be familiar, this is the one-on-one course, right? So if you're advanced beyond this, please head over to the more advanced platforms. But we just at the door waving everybody in. A dividend is a portion of revenue that a company gives to the stakeholders, the shareholders of the company. So if we made $100 million this quarter, we give a certain percentage of that to you for believing in us growing and continuing to get bigger, right? So we will dole out, we will pay some of that money back to you. That's great, but it is better to invest in companies that do not offer a dividend and will see, like tremendous growth than it is to invest in companies that give dividends that do okay and they drop off and they come up a little bit, but they drop off and they come up a little bit. And I'm not saying, and that's not exclusive to all companies that give dividends. You have some companies that have been giving dividends now for, you have aristocrats, they call dividend aristocrats. They've been giving dividends now 25, 50 years, which is great. But if you notice about the stock price, it pretty much stays the same. So you're not looking for growth in that, you're looking for consistent income whenever you dividend invest. But I want to make that a note. Just because a company gives a dividend does not mean it is a good company.
I agree with him on that too. Yeah,
does not mean that.
Right, because you can be losing money by actually just investing into a company that just give a high dividend but their particular stock is not performing, or their company is not performing well.
Right.
So you end
Right.
up losing money versus really gaining money, because you want your money
Right.
to actually grow, you know. Now you might have, like you said, you might have some companies out there that has growth and a good dividend.
Of course.
You won't find too many. I don't believe you'll find
It's not
too
too many.
many out there
Yeah.
that actually has a good dividend and
Right.
also grow. I mean,
Right.
it's kind of like you're taking like a pick, but you want to
Yeah.
actually, like you said, you want to do that pick where you're gonna have
Yeah.
the growth, because that growth
Right.
is gonna kick you back more money.
Right. Yeah. And not to
For
cut
your
you off,
investment.
Leroy, I think so. Not to cut you off with that. When you look at now, I'm an industrials guy. I love the industrials, right?
Hmm.
The industrials is that's a good sector to give dividends. That's because you're working with heavy machinery equipment, right? One of my favorite companies is Caterpillar. So, and they have years of dividend history, right? Giving people, but their stock is continuing to grow, right? It's a good company, quality company. It has the lion's share of heavy equipment, right? When you don't even have to see Caterpillar's logo on any heavy construction equipment on the road. When you see a yellow forklift, when you see a yellow crane lift, you automatically assume, oh, that's Caterpillar. It could be whatever brand. But once you see that Caterpillar yellow, you know that's, oh, okay, cool. It has a lion's, it has name recognition, right?
Ooh.
It's a quality company, quality products. They give dividends, but they're also on the rise. Not to say those companies, again, you'll find a few. Like I said, with industrials, you'll find those companies that a lot of them have, a few have, I won't say a lot, but a few have that slow growth, and they also give dividends. And then you have companies that they stay pretty flat, but they give a dividend, right? And because that money going to you, the stakeholder, is not going back into the company.
Right.
So it's sort of a sacrifice in that. If you look at most technology companies, Tesla, for example, does not offer a dividend because they take all the money and the revenue that they make and put it back into the company. That's only going to grow the share price. So Caterpillar might grow 20% a year. Tesla might grow 50%, right? And so Tesla might go from 1,000 to 1,100. Caterpillar might go from 198 to 205. Still growth, but one made essentially a leap and the other took a few steps, right? But it's all about finding those companies with that because it makes more sense. And this is not, none of this information is new. I will say this every single episode. I'm not repeating. I'm not coming to you with any concepts that haven't been doled out, right? You just haven't heard my voice and my presentation in the world say it in the way that I'm saying it. So let me say it to you. It makes much more sense for you to invest in a company that's going to turn that money inward, hold it in, give it to each part of itself and grow, feed itself, get bigger, and then you go and pull a little piece out, then going over to a company that says, hey, give me $1, I give you $1.25. Oh, okay, that sounds great. That's here. Let me give you $10. Okay, cool. Then I'll give you 25 cents per dollar that you give me, but they're not growing. And again, those things are not exclusive. You don't have to, a company that gives a dividend is not necessarily bad, but there are a few companies that give dividends that are worth investing in because they grow at the same time.
Yeah. So another company that comes to mind is Pepsi.
Mm-hmm.
Pepsi actually is a company that actually grows because they have actually not just invested in drinks, like they're actually invested in like chips, you know, also too. They're investing, even though they're investing in drink, they also invest in healthy drinks also too. So
Mm-hmm.
Pepsi, right? You would think when you hear the word, I mean, when you hear Pepsi, you would think about just drinks, but they have expanded themselves into other products. See, and their dividend is also pretty good too now. So
Right.
so like he just mentioned, the company he just mentioned. So Pepsi also like there's a few out there, but that's one that actually
Right.
gives a pretty good dividend and also has growth
Right.
too. You know,
Right.
so I always ask
Yeah.
people, I say, which company would you invest in? Coca-Cola or Pepsi?
Right.
Now, most people they're like Coca-Cola. Bam, that's
Right.
it. I'm like,
Right.
all right. So let's just check out some stats though.
Right.
And then once you actually look at the stats, oh shoot, I didn't know Pepsi was on their stuff like that.
Right.
You know,
Yeah.
so you have to make sure you're checking into those particular stats. Like
Right.
what products are they invested into? What
Right.
are they being innovative? How they're looking on the chart. The chart always tells a
Right.
story. Their finances. So you want to kind of make sure fundamentals is what we call it, but how they're looking out in the news, you know. So you just kind of keep that in mind whenever you're actually, investing in these companies.
Yeah.
So most
And
important,
Coca-Cola is not a bad company. Coca-Cola is they offer a good dividend as well. So both Coca-Cola and Pepsi are good. But to add to what Leroy was saying, Pepsi and Coca-Cola are not just invested in one sector of the market. They don't just offer drinks, chips, and sodas. They have other ventures as well, right? So when we think about, I just mentioned Caterpillar. Caterpillar is a heavy equipment company, but they're also heavily invested, as any smart company would now, at least for the next 100 years, invested in technology. They're automating a lot of things. All of these companies automate everything. So if you don't have some type of investment, you don't have some type of partnership, right? Because it's all about partnerships. It's all about being strategic about your business. So Caterpillar investing in artificial intelligence to run their heavy equipment 24 hours a day, 7 days a week is going to mean what for a worker who's operating that crane lift? You either become an information technology specialist or a computer specialist, or you find another job. And those are limited, few and far in between. So you have to pay attention to, outside of the services that they offer to you, the products that they offer to you, what other industries are they partnering with and they're looking at. There's not another Square, right? Cash App is hands down the most popular currency exchange platform in America. Like, hey, Cash App me that. It has become the Band-Aid of financial technology. So it's not smart for Pepsi to say, we're going to create our own fintech. No. But if they have a partnership with Square that allows them access into, it allows them to get, promote some of their products, that was a good strategy. They made money for their shareholders. They can keep growing. They can continue to make these ventures. So it's all about partnership, and it's all about, again, like Leroy said, innovation. It's all about how are you building your company and how are you tapping into each sector of the market.
yes. All right. So, we're going to right now switch gears. We already mentioned some stocks already, so
We
we're gonna
did.
do some. We're gonna do some stock picks here.
Of course.
For you all. So, Chris,
Yes, sir.
what's your stock picks, my man?
Oh, what it's looking like, what it is. So I'm going to mention, so I'll give you three. So this week for me, the companies that I like the most this week: Tesla, Amazon, Google. Amazon and Google are splitting this year. Again, it's the 2nd of April, 2022. So they'll be splitting over the next couple months. I believe Amazon is in June, correct?
Yes.
And Google is in July.
Yeah.
So they will be splitting. And Amazon, I believe, is 19-1, 20-1. And Google is the same.
Yeah,
19 to
20-1.
20
Yeah.
to 1. Okay. Both great companies. Fantastic. They're only going to get bigger and grow. They're splitting because they want more investors and they want to take over the world. And with it, fantastic. Tesla, I mentioned because next year, hopefully they do a stock split before the end of the year. So that way Christmas gifts can be Tesla shares for the family. I would absolutely love that. That would really be fantastic. But if next year they split, that's fine too. It's good to get into all three of these companies before and after. Why did I pick these three companies? Tesla is the #1 electric vehicle manufacturer and distributor. I think globally. I think Tesla has it globally. I'm going to say Tesla has it globally. Amazon is pioneering the way people get things. They've moved beyond books, and now they're moving beyond Earth and going to the moon. I'm with it. I love it. Google is essentially the only search engine. I'm not going to call out any of the other search engines. But if you need to know something, Google is now and has been for some time, but it's very important to hone in on this and try to conceptualize this. Google is a part of the English, scratch that. Google is a part of the human lexicon. It is a word in our language that did not exist 40 years ago that now exists. It's universal. It's common knowledge. Everyone, everywhere in the world knows Google.
Yes.
100 years from now, 200 years from now, if we're still here, if human civilization is still around, and this place is not literally on fire, Google will go down in history as one. Google will still be a part of the lexicon. It's a part of the lexicon. It's a part of our collective understanding of language. Someone that I don't know, I say, hey, Google it. I am never going to get, well, what's that? That's never going to happen. So it's very, very important that it's a part of our language now. It's a part of our culture and our understanding of how we search. That's practically the only search engine.
So I'm going to say 2 ETFs.
About to go get lit. Of course.
So
all right, 2. Got you.
First ETF is BLOK.
Okay.
It's called Block.
Block, yes, sir.
BLOK. All right, so we know that this year, right here, right? We got the government talking about they doing some testing on getting into blockchain, right? We got where like Bitcoin, Ethereum, they have gotten more traction, and Ethereum has its own blockchain where people can actually buy tokens off of it. So, and then you also have binary too. Oh man! So binary also, which is another cryptocurrency, has a blockchain where you can buy tokens off of it too, which is more feasible than Ethereum whenever actually purchasing, tokens. Matter of fact, binary ranks #4 within the cryptocurrency because Bitcoin is #1, and then it's Ethereum ranks #2, and then you got Tether that ranks #3, and then binary actually ranks 4. So a lot of people is starting to get into this crypto space. You know what I mean?
Yes, sir.
So you even got PayPal that actually in the crypto space where you can be able to actually purchase crypto on there. You got your Coinbase. You can get crypto on there. All right.
Cash App. You can get crypto on there. Yeah.
You get crypto on there.
Do that. Get you some Bitcoin on Cash App and be happy with yourself in 5 years. Absolutely. Yes.
See? And Now Bitcoin right now, right? It was down to like kind of like 38,000 or something like that. All right. So now it's up to 47 something thousand, I think, or something like that. So it's starting to get back up to, because it hit 62,000. So it's starting to move its way back up to that 62,000. Guess what's going to happen though? What's going to happen is it's going to pass 62,000, and then it's going to take a breather, come back down again, and then it's going to shoot back up again. It's a pattern
Yeah,
that happens.
the pattern.
But let me get back to this block, BLOK, this ETF.
Okay.
All right.
Okay.
So
Okay.
within this ETF, you have some of the names you will recognize is NVIDIA is inside of block. What's else inside of block? We got Coinbase, that's inside of block. You got PayPal, that's actually inside of block. You have the CME group, that's inside of block. Now the CME group, I think if I'm not mistaken, I have to double check, is where people use the kind of like it's a what you call it,
It's a
uh
hedge fund
it's not a hedge fund, it's
Okay.
actually order flow.
or a family office. Okay. Got you.
It's
Got you.
order flow where people have to, go through to be able to actually purchase. So it's an order flow
Okay.
company basically.
Okay.
um so that's even inside of block. Now block
Okay.
right now is like only $34
Right. It is that
and $11.
I remember looking at that ETF specifically. It is down from, I believe, $50 a few months ago. But the
Yes.
companies that it has in it. So I think what's important for people to do for exchange traded funds ETF, and we'll get into that into a later video. I think what is important for people to understand about ETFs is you want to look at their top holding, because an ETF is not just good because it has 60 companies in it. An ETF is good because it has 10% Tesla, 10% Square, 10% Apple, 10% Microsoft, so on and so forth. It has all of the top companies in its space. You want to invest in the best because that's going to bring you your money. There's a saying in finance, you want to move with the whales, right? If you think about the ocean, the biggest animals in the ocean, as far as we know, are whales.
Right.
So you're not gonna compete with these whales as a seal. You're gonna swim along with them because they know they're dictating which way the currents are going. They also know where all the food is. So whatever scraps they have that falls out of their mouth, that falls on, you right there to pick it up. But then guess what happens? You get bigger and you get bigger and you get bigger and you become a whale, right? And as you get bigger, you get it's the food chain. You begin to consume smaller animals, smaller plants. As you get bigger and bigger, everything under you is fair game, right? But you move with the whales. These are the investment groups. These are the Berkshire Hathaways of the world. These are the Black Rocks. These are the Vanguards. They decide where the market goes. So it's important when you look at an ETF to understand that just because it's an ETF and it has 60 companies in it, that means nothing. What are the holdings of this company? A certain amount of money was given to this group to invest. What did they invest in?
Right.
What's their goal? What's their long-term play?
And if not mistaken, Square is actually in this company also, in this ETF also too. But it's not in the top 10 right now. Because like you mentioned, you have like 50, 60, companies actually invested in it, but they usually show like the top 10 holders.
Right.
All right, and then so the next ETF that I want to mention is this is actually called BUG, Bug.
Okay.
Bug. So with this particular ETF, you have where like now this is kind of, I guess, for people that's in the technology, IT world, whenever it comes to security, you all would actually recognize some of these particular names that they have inside of this ETF. Like for example, uh, they have a Zscaler in here. Zscaler is one of the top, like, well, I'm sorry, not top, but what I would say is Zscaler is a new company that actually came out, but with them actually coming out, they have created a name for themselves whenever actually dealing with anything with internet, securing,
Is it a cybersecurity? Yeah.
with cybersecurity, yes.
Uh-huh.
So you got Zscaler that's inside of here. You even have CrowdStrike that's actually inside of here.
That's very popular. Yeah.
Yes. Oh man, Fortinet. Fortinet, hands down, they're doing the thing. That's
Okay.
actually inside of this
Yeah.
one
Yeah.
too.
All right.
Matter of fact, Fortinet stock right now, if we take a look
Mhm.
at it, let's see, let's take a look. Let me take a look here. Fortinet, FORT. Um,
Fortinet, Forinet, correct?
yeah, FORI. Yeah.
Fortinet or Fortinet?
Oh, no, FORTINET.
T. Okay, got you.
Fortinet.
Fortinet. Okay. Right.
Yes.
Fort, the prefix being strong. Got you. Okay. Right. Fortitude. Okay.
Yes.
Fortinet. Yes, absolutely. Strong.
So
Okay, absolutely.
that stock right now, right? Fortinet, and I'm looking correctly,
Hmm.
it's at $339.01.
Mm. And this is up from what, 6 months ago? Just to give people perspective on company growth, or even a year. Where was this stock April 2nd, 2021?
Okay, so April 2nd, 2021.
Mhm.
Let's see, hold on. It was April 2nd, 2021.
Mhm.
It was
And
at,
the reason I'm saying so, okay. So while Leroy is finding this, the reason I'm saying this, folks, is because it's important that a company grows. This company should not have been $500 last year, and is now at 300. Did you find the price, Leroy?
it was
April
actually
2nd of
at,
last year.
hold up, last year, April.
Mm-hmm. Mm-hmm. And not even April 1st, not even the 2nd, but in April of last year, where was this company?
If this is correct,
Uh-huh.
it was at 200, 200,
$200. Yeah.
200 and, oh, it was like at 200.
Mm-hmm.
Go up. Oh, 200, like $3,
203. And it's at 300, and what you said now, 350,
$39.
339. That's $136 in 12 months added on per share. The power of investing. The
Yes.
power of investing.
Now this is the same company that's also in this BUG ETF
Mm-hmm.
also too. I was wondering, I think it's like the second one actually
Mm-hmm.
in BUG. Let me just double
Mm-hmm.
check to make sure. And this BUG stock, I mean ETF, is only $31.51.
Okay. And now, is this an upward trajectory? They've been going up. Is there a debut date on Bug? When was Bug available on the public market?
Let's
Were
see
you able to
here.
see that?
Mm.
Because if Bug has companies that are going from $203 to $339, their price is also, the price of that ETF, BUG, is also going to go up. Now, again, like with single stocks, like with Tesla, like with Square, like with Microsoft and Apple, you want to find ETFs that are growing. And again, if they're moving with these whale companies, right? And a single company is not necessarily a whale, but hedge funds are typically the whales being referred to in economics. But if Bug is scooping up chunks of the largest chunk of scraps or the largest chunk of equity in these whales that are moving the market, they're going to grow at a pace larger than that of you or I doing that same thing. We're still going to grow, still very important to invest, put your money in, that micro investing you want to do every week, every 2 weeks, every month. But you can also put your money behind them.
Right.
You
Okay.
put your money in the whales, and you can put your money in the meso layer. Yeah.
All right. So let's say, all right. So for example, back in last year,
Okay.
January of 2020, it was actually at.
Oh, this was a couple years ago. Okay.
2020? Yeah.
Yes, sir. Yes, sir.
It was actually at, what's that, $17.
Mm-hmm.
And so now year to date, it's up $31.51. So over the course of 2 years, it was from 17 and it grew to 31. And that's what it actually kind of being down right now.
Okay. So it's grew. So you said the price was what again in 2020?
Oh, it was like at 17. $17.
Okay. And it's at 31 now. So again,
31 now.
That growth from 2020, 17 to now 31, that $14 addition, right? So do you see the single company for the net 203 to 339, and you see the ETF that has that inside as a portion of that 17 to 31. So it was an upward trajectory. Right? And I don't know when they included it in there, but it's going up and it continues to rise and it continues to go. And as long as it does that and it performs for you, you keep investing, right?
Right. So those are two ETFs I want to just give your put on your radar to check out, which was the BUG, which is dealing with cybersecurity, and with Block, which deals with basically the blockchain of cryptocurrency. So security is definitely where is continuing to grow, because a lot of things now need security. Whenever protecting your information, your network, so that continues to grow. And then even with this pandemic stuff that happened, before.
Yep.
And you needed some type of because you had people working from home, so inside of their office they would actually have to secure their network so people can be able to actually get on with a VPN, getting into the network. So all that stuff had to be secured. So therefore, with cybersecurity, so nobody want to actually hack into people's computer. Even today, even with people going into the office, that network stuff is starting to grow more. So I'm just giving you an ETF that actually where like keep an eye out on, because this is where stuff is actually moving toward. Even when it comes to even the cryptocurrency space. That's why I gave about the Block, BLOK.
Right.
It's not going anywhere. I'm telling you right
Right.
now.
Yeah.
People are
Yeah. No,
definitely
blockchain is
adapting
here.
it, you
Yeah.
know.
Yeah.
So
And that, so to sort of put a stamp on it, to make the final point, when you're looking at companies to invest in, you're looking at the future. You're investing for pardon me, you're investing for 5 and 10 years down the line. So always remember that when you are investing. I will say the companies that I'm going to invest in this week are those companies that I listed to you earlier. Tesla, Tesla, Amazon, Google. Microsoft, I'm already invested in. I will continue to keep that investment going. It is a great company. Okay. So put in what you can when you can on a consistent basis. And we'll expand on dollar cost averaging in future episodes. But you want your money to work for you so you don't have to work for your money. Your money, these are your soldiers. Your money never sleeps. So your money is constantly working for you. It's constantly being put to use. So put your money in the market, keep it there 10, 20 years. You'll be happy with the result. Was there anything else, Leroy, that we didn't cover here? That because we're gonna cover some stuff, but we just wanted to, hey, invest.
right.
That
And then
micro investing.
right. And then some of the companies that actually mentioned in this ETF, like for
Mhm.
example, if you look at PayPal, we know that's a solid company.
Mhm.
So,
Mhm.
or if you look at Square, we know that's a solid company.
Mhm.
So these
Mhm.
companies that I'm telling you all about are
Mhm.
are solid companies. So I'm not just mentioning
Mhm.
companies that, of course, we're looking for the future, yes, but these are companies kind of already kind of some of the companies that actually in the ETF, they are kind of like just getting started, but you have companies in here that's also solid too. So I just want to
Yes.
make sure to mention that, especially
Yeah.
even when I mentioned the Fortinet, it uh even though that's moved toward the future, but look how fast it have actually grown and it's continued to
Right.
grow, you know.
Right.
So this
Yeah. And when I mention future, I mean companies that are here right now that will dictate the future. So we're already in the future. So companies, when I say invest in the future, I mean invest in good companies now that will be here 40, 50, 60 years from now that will still be moving the markets. So put your money in, keep it in, let it grow for you. I'm going to invest. So my micro investing this week, I'm going to do $20 split between Tesla, Amazon. What was the third one? It was
it was Tesla,
another,
Amazon, and
and
Google.
Google. So I'm going to do, and I already invest in those companies. So it's just difficult. I should be able to, but it's already, so my micro investing for this week, Tesla, Google, Amazon. Next week, and we'll track as we go along the show of development. We'll track progress and things of that nature. But I want you to put your money in the market. I want you to keep it there. I want you to hold it.
Yeah, my micro investing is actually going to be NVIDIA.
Okay.
NVIDIA is going to actually be uh, Google and Amazon also too.
All right.
So
Listen, fantastic. So start this journey with us, y'all. I think that's a perfect way to end our episode. Leroy, anything else, man? I'm good. You got anything left?
make sure you all like and subscribe and comment for the who, the CoWaCo, because we in the
The
building.
company water cooler. Yes,
There you
sir.
go.
We'll see y'all on the next one.
All right.